So, as everyone knows, this week will be quite hectic in terms of data. We didn't have much of a big data of last week. So the market was kind of slow. Let's have a look on DXY here, 4 hours. So as we can see, last week, first day was on the, let me have a look on my calendar, was the 6th. So from the 6th here, let's get the vertical line, 6 to Tuesday, Friday here. There we go. So that was pretty much the whole momentum of last week. So pretty much nothing. Okay, we started on here. Started on here. So pretty much from there to here was 0.21% up for the DXY. Of course, we did had some move up, and then some move down, pretty much 50%, I guess. Let me have a Fibonacci here. The whole move up now to the whole move down. It's pretty much 61% of the Fibonacci. So quite interesting where the levels of the US dollar is holding at the moment. I do think there is a possibility of a continuation for a downtrend until this area here. Okay, oopsie, sorry, this area somewhere here. Okay, so that's the third time I try to draw a straight line, but anyways, somewhere between those levels here. Okay, why do I think that? We're gonna have a look on that today. And of course, for those who know me, the pair I was talking about on the YouTube video is the euro dollar. So I do have a huge probability for the euro dollar go up this week. Okay, and has already started to do that. Because we can see on the market, let's go for jump euro dollar pretty quick. We can see this trade here becomes invalid now, because for some reasons I will mention. Okay, but remember, I've mentioned that this 1085 is a good level of approach for the market, and we still have 63 pips, all right, 635 points to get there, or if you prefer 0.6%. Okay, now why do I think this will happen this week? Because we do have some big data coming out, and we're gonna have a look on that right in a sec. But just bear in mind, guys, last week was similar to nothing. Okay, so when we zoom in to the chart, okay, so let's have a look on here. When we do a zoom in, this is a 4-hour chart, and I'm just looking at euro dollar, but let's go for the 6th on Monday to Friday. Okay, this was the move. Okay, so from here to here, so pretty much nothing. All right, of course we went the move down, and then we went the move up, and then we finished. So pretty interesting. Okay, pretty interesting on what's going on with the market at this moment. But let's address now what actually makes sense to us. But it's pretty clear an uptrend here, as we can clearly see the market broke these and then broke the upper level, and then now continuing to do high highs, then another one here, and then we are looking to break this one now, and this is all important, and this is the Fibonacci if you want to do the Fibonacci. Okay, And if you want to do a Fibonacci retracement, sorry, extension, you would be looking to something like that. Okay. So that's pretty much it, what I'm expecting, I would say, for euro dollar at this moment. So an up move there. Anyways, so let's go for the economic calendar. Hopefully everyone can see my screen. It's all good. Now, let me just put this on the right timing. So just for this week, we had yesterday similar to nothing. All right, we only had the Eurogroup meeting. We had the second consumer climate for the Swiss. We had NAB business confidence, and that was pretty much it. Of course, the member master giving us a speech from the FMC. Now, on Tuesday today, we just had the UK employment change, as well as the average earnings index plus bonuses, and the German CPI at 4 p.m. on Sydney time, so 1 hour and 12 minutes ago. Now, when we look for the employment change, well, the unemployment rate as well. So when we look to the employment change and unemployment rate, employment rate came in as expected, but don't ever forget that if we look as the previous was 4.2 and it came at 4.3. Oh, but it's not green. I know it's not green because it's just not higher than the consensus. But that doesn't mean that this is not good or not bad or whatever. All right, it's neutral. No, this is bad. Not like so bad, but this is bad because it came higher than the previous. So there are more people getting unemployed in the UK. Okay, that's pretty simple observation. German CPI came in as expected, 0.5, so nothing crazy on there, but continuing to go higher than the previous. Previous was 0.4, consensus 0.5. It came in as consensus expectations, and then we had Spanish CPI came in as expected, but continuing higher than the previous. And then we're going to have today at 10:30 the PPI. Okay. And I want to focus some of the attention of today's webinar to the CPI as well. That the CPI will be tomorrow, okay, on 10:30 Australia time. So you already know every country has a different time, therefore have a look on what's going to be on your current time zone. We're going to have retail sales as well for Wednesday, and the GDP for Europe on Wednesday. Okay, just a second, guys. What else? Yeah, that's all. And then on Thursday, we have crude oil investors as usual. We have the employment change for Australia, unemployment rate for Australia, ECB financial stability review, and initial jobless claims as every week. And then on Friday we get there you go, the CPI for Europe, okay, and that would be it. Now, if I would put in a let's say in an order, which one is more important than the other, I would probably do something like that. Okay, so I go with US CPI, and then US PPI, and then Euro CPI. Someone sent the message. CPI and PPI, I think so. Yeah, definitely they are very important. That's what I say. So US CPI being the first, US PPI being the second, Europe CPI being the third, and then of course the Europe GDP being the fourth, and the last one um, is the, where is it? Where is this? Oof, there we go. The German, what here? The German CPI. Okay. Why do I always say that the German are important? Okay. Oh, sorry. I don't mean this. Let's just put CPI being the fifth. And then below that, we have these pictures. Let's say speakers. Speakers from central bank. Now, why do I say that the German CPI is important? First of all, we need to understand that Germany holds a big part of the whole Europe. Okay, therefore, whatever happens in Germany, there is a big probability that happens in Europe as well. And another thing is the manufacturing on German is very, very effective. All right, so this is a leading Europe economy, leading the Europe economy. Exactly, that's correct, Lawrence. As this, I wouldn't change the words. So this is would be the week priority for this week. Okay. Sorry if I've misspelled this, but anyways, so that would be the week priority for this week, starting on the oh, where go when the on the 13th to the 18th, I think. Okay, oopsie. There we go. All right. So this is it. Now, as I've mentioned, US CPI is the priority. I want to know from you guys, what are you guys expecting? Tell me, what are you expecting? Do you think that the US CPI will come higher? You think that the US CPI will come lower? What are everyone looking for? Stuart say that it's looking to come lower. Lawrence, what do you think? It's Wednesday. There we go. Wednesday. There we go. So just for again, the CPI year-over-year is expected to decrease, and the CPI month-over-month is expected to stay the same. I think the US dollar is more sensitive to a downside surprise. Good. It's supposed to be higher, but I'm getting more confidence it will be rigged. I'm somehow in the middle. Okay, somehow in the middle. Right. So most of the people here is expecting the inflation to come lower. Did you guys read the text I've uploaded today on the Telegram? If you did, then congratulations, because I am expecting the inflation to come lower. And we're gonna have a look on that now, if I can. Yeah. Can you guys see this? I think it's just sharing, right? Let me check. Yeah, it's good. Okay. So Wednesday CPI could be a big miss, okay, from what everyone is from what everyone is saying on the market, that the inflation continues to go higher, therefore most probably, you know, we will continue to have another CPI higher. First of all, we had a sequence of 5 CPIs meeting the expectation. Okay, so after last month, the market gave up the hopes of a rate cut that they had, and they reduced the easing expectations to just one cut for this year. Okay, but this is late 2024. That's not going to happen like next month. All right, I'm talking about September, October, even November. All right, but we can't forget one crucial point here. is that the election is coming. All right, it's right in the corner. So it's like you will blink, and the election will happen. All right. So therefore, the Fed is turning a little bit more political than I've ever seen it. And the US President Biden, he predicted, all right, I'm going to use the word predicted because this is stupid. This is not his job. He shouldn't be doing this. But whatever he do whatever he wants. I'm not his dad to tell him to do this or that. But I just think that it's nonsense. All right. But anyways, so he predicted that the Fed will cut the rates before the end of the year. But what does that actually means, and why he's saying that? Well, before the election, he just want the Fed to cut the rates before the election. Okay, since before November, I guess. All right, 2024 would be sorry, after anything after November would be more benefit for the Trump, okay, for the Trump government. So what I'm looking here, okay, I don't like to say conspiracy theories or maybe use like the market is rigged or something. No, but this is real, all right? This is not speculation. I'm talking about something plausible, all right? Something that we can actually understand it. Now, do you actually think that do you think the Biden and the Democrats will allow the perception of the American consumer to deteriorate to the point where even the most radical left-wing communists, all right, they will want to vote for Trump? The answer is pretty obvious. It's no, right? Obviously not. The numbers will be even more manipulated from now on. Okay, so that by November, the economy will be like a artificial state of survival, right? And looks healthy, but it's not healthy. It's like um, it's like Subway, like, oh yeah, we are a healthy company when it's not. All right, so that's pretty much it. So it's gonna be very, very funny. All right, this Netflix series. Let's call this the Netflix series because what we're seeing right now is just a stand-up comedy. Now, moving, we have this other chart here, right? This is the OER. I've took this from the Standard Chartered Research. It's a bank, pretty big bank. And one of the analysts as ACY, he came to me and said, "Oh, do you have the research from the SCR?" So that's the Standard Chartered Research. And I was like, "No, probably not, but I will have a look on you at my terminal." And then luckily enough, I had it, and it's here. All right. It's not the whole thing. This is just one figure, or figure one. They had all the explanations of the model and everything, but we don't need to go through that. But I've just brought to you what you actually need to know. So he was looking at the OER inflation equation points to sharp drop in the coming months. So the very weak green-ish, I think, line is the predicted. The strong green line is the sample, and it's an in sample, all right? And the blue line's the OER, okay? So the OER, it means owner equivalent rent, right? Now, he made 4 points, right? Actually 3 points. I will touch base on them now. The first one is the slowdown in rent inflation. Okay, so the analyst from the Standard Chartered Research, he is a chief currency strategist. His name is Stephen England. All right. He's foreseen a significant reduction on the OER, so on the owner's equivalent rent. This is a very critical component of the CPI, the Consumer Price Index. Okay. Regression analysis are predicting an average inflation of only 0.29% month over month in the second quarter for the OER, and which is substantially lower than the 0.48% observed in the first quarter of 2024. All right, in quarter one this year, January, February, and March. So this is a big drop on the numbers, all right? We're coming from 0.48 to 0.29%. That's good, but in as well, it's not good for the US dollar. Anyways, the second thing is the political impact on the rate cut expectations. With the we're approaching the US presidential elections, and the political statements, they are indicating there is a possibility of a rate cut by the Fed before the year end. All right. So let me bring it here. Let me bring it here. A CME, the Fed Watch 2. So the 12th of June, all right, next month, no one is expecting anything. So just a pause, normal. Remembering that the current target is at 525 to 550. Rates are never set in one thing. Oh, it's 5.5. No, it's 525, 550, because you need to have a little, room for the bonds, for the yields to go up and down and so on. On the 31st of July, no one is expecting much of the Fed. So 74, majority of the market is expecting a pause again. Going to September, 49.6% of the market is expecting a cut on September. And then November, everyone is expecting a pause. Okay. And then in December, everyone is expecting a pause again here, 35.6, 34.6, so 1% of difference. Let's call it a pause, because this must probably not happen. Okay, so this will go a bit from here, a bit from there, and these guys here, we'll see that this is impossible. We'll jump from here, and these ones. So let's call it even. Let's call it even here on 18th of December. Okay. So the highest probability right now is that the Fed will cut in September. Isn't that cool? Because everything after November won't benefit the government. It will actually say that, oh, okay, Biden is not good. Biden have the higher rates forever. This is really not great. And then Biden came in, and then the first thing when Biden is on power, what the central bank does, go and cut the rates. The population will be like, oh, that's awesome. That's fantastically good. Like Biden is on power now, and we are booming because the rates are gonna come down now. Sorry. So that's exactly what I was talking about. Obviously, the numbers would be much more manipulated from now on, so that by November, the economy will present sort of an artificial state of survival and looks healthy, but when it's not. So we have 2 months ahead, June and July, to September, a cut. So we're not far. We're definitely not far. We are 2 months and a half. Okay. Well, let's say 3 months here. Okay, because half of this month, half of September here, that's a month, and then 2 months, so 3. Okay. So most of the probability right now is for a cut of 25 base points on November. Okay, as I've mentioned, there is a big impact on the political impact on the political side of the things for the rate cut expectations. Okay, so they need to do this before the year ends. So the expectation that inflation will need to decrease to justify such of those cuts, because we know that inflation is not decreasing. But remember, they can easily manipulate the inflation numbers. So if they do start to manipulate, we will see inflation come lower already. Okay. It seems like a very clear trade for me here. Seems like a very, very clear trade for me here. This is just a thesis of investment, and this is my thesis. Okay, I've built this throughout last week and the week before. So it's not for you to follow it. I'm not saying to you to do this or do that. No, definitely not. I'm just sharing with you what I've mentioned on the YouTube video, that I'm actually looking at a big opportunity on the market. There is the euro dollar at this moment because of the manipulation of those numbers that must happen, all right, for the Fed to cut rate in November, in September. Okay. Now, this may influence how the data will be presented or perceived by the market, and this will lead to a potential negative surprise in the report, all right, for the CPI. We can notice that these observing the polls confidence in delivering a dovish speech at the last FOMC meeting on the 1st of May. And also we had the Yellen and the Bank of Japan intervention. This looks like perfect, doesn't this? It's like perfect timing. It's just like, whoa, this is crazy good to be true. Well, it is not true, but it's a synthetic truth. Okay. So the third thing is the lagged data and the random fluctuations. All right. So the experimental data used to estimate the OER, the owner's equivalent rents, they are based on a very small sample of rented single family homes, and they are collected in a quarterly basis. Okay. So this can be very good, but this can also be very wrong, because we have only a very small set of data, okay, predetermining that this will actually happen or this won't happen. Remember, this is a model, an economic model, a quantitative model. So quantitative model, that's there is margin for error here. All right, it's not. This is a very new thing, the OER. So there are lots of possibility for this to be wrong as well. And the whole trade idea comes to a collapse, right? But as I was saying, it's based on a very small sample of rented single family, all right, single family, and they're collected on quarterly. So this can lead us to a random fluctuation in the monthly data, and this of course will result in an estimate that may not fully capture the current trends in the rental market. Okay, so just be in mind. But anyway, so as I was saying, here is the Goldman Sachs Global Investment Research saying that we expect CPI shelter inflation to run at a similar pace to the last months as rent growth decelerates, but the OER rent gap normalizes months decline. Okay. So, and this comes to the fourth point. There's a disconnection between the real-time metrics and the CPI data. Okay. So there's a significant lag between, we can see this on this chart, very, very clear, okay, that the metrics in the rental market and the representation in the CPI. So currently, even if the rents are starting to rise in various parts of the country, I'm talking about US, this will not be reflected in the CPI data until 2025 because there's a lag and there is a disconnection between the real time and the real CPI. Okay, so remember I've always mentioned about the lag. we need to look for it on here, okay? So this then, which may result in a lower than expected number for the upcoming months. So again, the OER is carrying a weight of 32% in the core CPI. So a decline of this magnitude from 0.48% month over month to 0.29% month over month, as I've mentioned on the second state of this talk we're having, this would reduce the core inflation by 0.06% month over month. Because if we have a weight of 33%, we get the actual CPI number divided by the month, then get the 32% of that, give us a 0.06 coming from 0.48 from the model to 0.29 from the model now on the OER. So then we have the 0.06 month over month. That this means that this variable alone would push the core estimates from 0.3% to 0.2%, if not lower. Okay, so if a few more items come in colder than expected, this could have even colder reading, meaning that this could be much lower. Okay, so looking at the CPI, where is this? Month of month here. This could be 0.2% if I'm right. Okay. This could be 0.2% if I'm right. And that would be very nice. But at the same time, I could be very wrong. I will take the risk on my own, and I will believe in my analysis, of course. Even if it doesn't come 0.2, there's a possibility of coming 0.3. So I'm between 0.2 to 0.3. Okay, that's my 10% margin of error. Okay, but could become lower than that as well. All right, so coming back here, yesterday we had the Federal Reserve that I've just mentioned, that he had a speech, and he was more hawkish, right, than the actual John Paul that was dovish on his last FOMC press conference. So he was emphasizing the need to keep the rates in a restrictive territory until there's a clear evidence of consistent inflation reduction. Do I agree with him? I certainly, most definitely agree with him. But we can look at the UK, for instance. I've mentioned that already. We had the inflation on 0.8% in October 2022, and now we're in 3.4, and they haven't cut the rates yet. Why would the Fed cut the rates now when they have a 3.4% inflation? Doesn't look too good, right? Well, this is exactly the reason, because of the elections are coming to a very close, very close end, right? It's gonna happen. They are sure of that, right? Anyways, so he emphasized that the importance of a clear and cautious communication to avoid misunderstanding and generate market certainty. So he quoted exactly as I'm going to say right now. The continued emphasis on observing and responding to inflation reflects a firm policy against persistent inflationary pressures, reiterating the Fed's commitment to stabilizing prices and sustaining economic progress. Definitely, he's hawkish. Okay. I most certainly agree with him. I completely believe that this is a plausible analysis of the economy. But again, the one thing that makes me think twice is the elections and the Biden. Biden says that the central bank will cut the rates before the year. If Biden said that, I know we can't much believe on him, but I know he's just a sleepy Joey. But still, man, he say that in front of millions of people, and this had a repercussion of immense repercussion. So the time is now. The time is on. There are lots of possibilities, lots of opportunities. All right. Do you see a 70s? Don't hold your breath, right? Do you see a 70s scenario like in the long term? Nah. I don't think we're gonna have another crisis or like the 70s, like or another real estate crisis or something like that. Nah, I don't believe on those. I think there are opportunities, definitely, but nothing too huge. Don't try to predict. Economists are always trying to predict the next crisis. And guess what? They always get it wrong. Okay. The market is random. Have you guys heard about Brownies theory? It's just saying that the market is random 99.9% of the time. So yeah, very hard to predict those stuffs and say, oh, this will certainly happen on this will there is a possibility of this happen. There's always a possibility of a bull run. There's a possibility of a bear run. Okay, so don't be too attached emotionally to those things, Julian. I'm not saying anything, man. I'm just, you know, having a talk to you, but yeah, I don't think so, man. It's everything has its time, and that time was completely different from the time of now. So yeah, I don't think so. Anyways, so there's one more image I want to show you, is this one. So that's the correlation between the euro dollar. Okay, so the euro dollar standard normal pricing and the calls and options for basically calls and puts for the Euro 1 month option. Okay. Pretty simple to see this, that we are having a huge gap. Okay. Having a huge gap from the option price to the euro dollar price. Euro dollar price is trading at 107.6, 107.5 between here, and the option price is trading at 0.2.5 maybe. Yeah. So 0.25, I mean 0.25. So this gap here, it makes me think, okay, this big boy needs to come down here, boy. He needs to go here. And this guy needs to come a bit lower. So we're talking about 110. All right. So the risk reversal on euro dollar continues to strongly point upwards. Okay. Following the bottom in the mid of April, as we just saw here. So that's interesting, guys. So that basically this indicator shows it rises when the demand for calls, basically the buy options, is higher than the for puts, the sell options. So basically there's more people looking to buy options than actually sell options. All right. So basically there's more people looking for calls. Okay. Lawrence sent me a message. In theory, yeah, it should be positive for euro dollar. Now it could be affected by PPI and CPI. Yeah, you definitely most sure about that. 100%. If we have a dump on the dollar, is it a better to long Aussie or euro? Now, that's exactly where we're gonna come to. So I've done all of this explanation and everything exactly to come now. Let me clear all of this and look at the euro dollar, because this is the one. All right, actually GBP USD is kind of good as well. GBP, just go here. GBP USD is a kind of good one. I got a loss on GBP USD here, but it's fine. look to the 1 hour, we still have this box here to be filled, okay? Somewhere around that level. So between all of the currencies, okay, we're gonna have a look at the commitments of traders now. But between all of the currencies, I still preferring the euro dollar for a long position, okay, for a long position. So let me log in into my terminal, and we're gonna have a look at some stuffs here. Just a second. Of traders. Okay. So if we look for the US dollar is negative 44.3%. Okay. And if we look for the euro is just down here, guys. Sorry, yeah, this is the US dollar here, and the euro is negative 2.6. It's still negative, all right? Still negative, both of them negative, but euro is less negative than the US dollar. Now, if we look from the last week to this week, we didn't had any flip, all right? So from US dollar, we're still negative. From the CAD, we're still negative. From the Japanese yen, we're still negative. From the New Zealand dollar, we're still positive. CHF, we're still negative. Euro, negative. Pound, negative. And Aussie dollar, still negative. We did have a flip to negative on the pound, but then come again this week, continuing to be negative, okay? Yeah, I'm not too keen to look at this as a speculation. I'm looking at a hedge of risk, most probably. We can see that hedge funds decrease a little bit the long positions on US dollar. Yes, they did. They did. From 46 to 40. From 30 to 35, 35 to 41, 42, 43, 46, and then they took it off 6 positions. Yeah, I'm rather preferring euro dollar than any other. I'm gonna stick with euro dollar, guys, for this trade idea. If we look to the euro dollar here pretty quick, let's have a look at the seasonality. It loads. But anyway, so looking at more technical, yeah, MUFG is long. MUFG is long. That is correct. So, looking at some targets, MUFG is targeting 110. That's correct. And I would be looking to some retracement. I don't know if I would just enter the market right here. Maybe here would be good. If the PPI comes higher, that would drag the move down. Otherwise, we're looking to go up right from today already. Let me see the volume. Why is not loading? Oh, well. It's bugged, unfortunately. Let me try to re-enter. I want to show you all the DXM and everything. Yeah, it's just doesn't want to load. That's all right. Let's have a look on FinLogix. Go euro dollar. So the market sentiment for euro dollar is 60.8% of the market is short. You already know what to do. So most probably we will be looking to euro dollar higher. All right. So I'm looking to long based on my theory. I'm looking to long with a 2% risk. All right, this is my personal idea. You don't, if you say like, oh, I want to follow your idea and then you lose money, it's just my idea. Okay. All right, this is not an investment recommendation, but I want to make this very clear because I'm very confident on this trade. So let's see how this will play out. Okay. Now let's have a look on gold. Gold is slowly going up and slowly going down and rapidly going up and goes like that. We've broke the top again. We probably can see gold retracing to this area to go up again. Right. Institutions and central banks continue to buy physical gold. Okay, I want to talk on that on I will talk about this on Thursday because I'm building an analysis for the gas, natural gas, and it's so crazy. I'm gonna touch about that on Thursday, but just so you guys know, I'm probably longing natural gas as well. And the US dollar index, I'm looking to this guy here, comes to this area, okay? The area of 103, 104, sorry, 104. I know, sounds crazy. I like crazy stuff. So let's see how it's gonna be. Any questions, guys? That was pretty much all I want to present for you all, my idea on Eurodollar, because I think there's an opportunity cost on US dollar is still very expensive. No questions? All right then. Thanks everyone for coming. Be here on Thursday. Okay. And if you haven't yet created your account with ACY, please do so. Test it out some demo with us, where you can see the spreads, you can see all the asset classes we offer, and test it out how we actually are good. Otherwise I wouldn't be here talking to you guys about these. So you can create a demo account easily in seconds. All right. And if you're not yet on the Telegram group yet, again, I will send the link here and you guys can join me there. Aussie dollar. Okay, Aussie dollar, I still continue to see an upward until 67. Okay, I've mentioned that already last week again. Okay. Most people laugh of me because I got this move wrong. Look, I don't care about this move. I care about this whole move. Okay. And my stop, if I long it here, it's not here. My stop would be down here. So 1-to-1 trade. Okay. So most probably we will continue to see Aussie dollar grinding higher, forming now a box, breaking this stop, being this the bottom, retracement up. Okay. Most probably this is what we're gonna see. Aussie CHF. Yeah, I'm not too sure about Aussie CHF, man. Very confusing market here. Don't look at this. Sorry. Yeah, I can't even tell you here. Between Aussie dollar and Aussie CHF, would prefer to trade Aussie dollar. Much more clear. All right, Sweetie. Thanks, man. Thanks, everyone. Have all a great week ahead, and we catch up on Thursday. See you all. Thank you. Have a nice evening. You too, Lawrence. Bye-bye.